Hello everyone. Welcome back to the channel. In today's lesson, we're going to break down one of the most important foundational concepts in accounting: cash versus accrual accounting. If you truly want to understand financial statements, how profit is measured, how businesses report performance, and why numbers sometimes look strange, you must understand the difference between these two accounting methods. By the end of this video, you will clearly understand what cash accounting is, what accrual accounting is, the key differences between them, why most large companies use accrual accounting, and how each method affects profit. Let's get started. 1. What is cash accounting? Simple and straightforward. Cash accounting is exactly what it sounds like. Under cash accounting, revenue is recorded when cash is received, and expenses are recorded when cash is paid. That's it. No cash, no transaction recorded. Example 1. Revenue under cash accounting. Let's say you own a small business. On January 10th, you provide services worth $5,000. The customer pays you on February 5th. Under cash accounting, you record the revenue in February when you receive the cash, not in January when you did the work. Example 2. Expense under cash accounting. You receive an electricity bill in March. You pay it in April. Under cash accounting, the expense is recorded in April when the payment is made. Advantages of cash accounting. Very simple to understand. Easy to maintain. Shows actual cash position clearly. Good for small businesses. Disadvantages. Does not show the full financial performance. Can distort profit. Ignores receivables and payables. Not allowed for most large companies under accounting standards like International Financial Reporting Standards and Generally Accepted Accounting Principles. And that leads us to the second method. What is accrual accounting? The professional standard. Accrual accounting records revenue when it is earned and expenses when they are incurred, regardless of when cash is received or paid. This method follows the matching principle, meaning revenues and their related expenses are recorded in the same period. This is the method required under IFRS and GAAP. Example 1. Revenue under accrual accounting. Let's use the same example. Service performed in January. Cash received in February. Under accrual accounting, the revenue is recorded in January, because that's when the service was performed and income was earned, even though cash has not yet been received. This creates something called accounts receivable. Example 2. Expense under accrual accounting. Electricity used in March. Bill paid in April. Under accrual accounting, the expense is recorded in March when it was used, not when it was paid. This creates accounts payable. 3. The core difference. Side-by-side comparison. Let's simplify it. Cash accounting versus accrual accounting. Cash accounting records when cash moves, while accrual accounting records when value is earned or incurred. Cash accounting is simple while accrual accounting is more complex. Cash accounting is used by small businesses while accrual accounting is required for larger companies. Cash accounting may distort profit while accrual accounting gives more accurate performance measurement. 4. Why accrual accounting is more accurate. Let's look at a practical scenario. Imagine in December, you make $100,000 in sales. Customers will pay in January. You also incurred $60,000 in expenses in December but will pay in January. Under cash accounting, December profit equals $0, because no cash was received or paid yet. That looks wrong, doesn't it? Under accrual accounting, revenue equals $100,000. Expenses equals $60,000. Profit equals $40,000. That reflects the true performance of the business in December. This is why investors, banks, and regulators prefer accrual accounting. It gives a more realistic view of profitability. 5. Impact on financial statements. Under accrual accounting, you will see accounts receivable. You will see accounts payable. You may see prepaid expenses. You may see accrued expenses. You may see unearned revenue. These items do not appear under pure cash accounting. Accrual accounting affects the income statement, the balance sheet, the statement of cash flows. This is why understanding this concept is foundational in accounting. 6. When is cash accounting used? Cash accounting is typically used by small sole proprietorships, freelancers, very small service businesses, because it is easy and requires less bookkeeping effort. However, once a company grows, regulators usually require accrual accounting. 7. The big picture concept. Here's the key takeaway. Cash accounting focuses on cash movement. Accrual accounting focuses on economic activity. Cash accounting answers, did cash move? Accrual accounting answers, was value created or consumed? That is a powerful difference. 8. Quick practical illustration. Let me give you a short summary example. You run a consulting business. January, you complete a $10,000 job. You pay $4,000 for staff salaries. Client will pay in February. Salaries paid in February. Cash accounting, January. Revenue equals $0. Expense equals $0. Profit equals $0. Accrual accounting, January. Revenue equals $10,000. Expense equals $4,000. Profit equals $6,000. Now you can clearly see why accrual accounting better measures performance. 9. Final summary. Cash accounting. Records when cash is received or paid. Simple. Best for small businesses. Can distort profit. Accrual accounting. Records when revenue is earned and expenses incurred. Follows the matching principle. Required by IFRS and GAAP. Provides a more accurate picture of financial performance. If you understand this concept clearly, you've just mastered one of the most fundamental pillars of accounting. If this explanation helped you understand cash versus accrual accounting more clearly, don't forget to like the video, subscribe to the channel, and share it with someone studying accounting. In the next lesson, we'll take practical real-life transactions and record them step by step under both cash and accrual methods, so you can see the difference clearly in journal entries and financial statements. See you in the next class.